One way to get stock ideas is to see what type of stocks other investors are buying. Whether this be super investors, you'd more want to look at what they're buying, or even people like YouTubers or article writers or people like that. You want to put less of a weighting on the YouTubers, the article writers, on what they're buying compared to super investors. But then nevertheless, you want to look at multiple pools of people, of other investors, see what they're buying, and just use them as potential ideas. Now, one of the stocks that a lot of both super investors are buying, if you go on Roma, and you look at the popular stocks that super investors are buying, I believe almost at number one, it is Google stock, Alphabet stock, same thing. And not only the super investors buying Google stock, Joseph Carlson has recently been buying it. He's a pretty big, maybe one of the biggest, most popular investing YouTubers right now. You've also got people like Everything Money. I just want to be crystal clear on this. I don't believe Everything Money has bought Google stock yet, but they do seem to be looking at it very closely and they do like the business. I think they're just waiting for the price to go a little bit lower. And also, Sven Carlin has said that he likes the stock as well. I don't know if he's bought it or what, but nevertheless, there's a lot of these people from different spheres who are buying Google stock. Now, the question is, first of all, why are they buying it? And then we need to kind of do our own analysis of Google and see, is this maybe a potential buy for me too? That's the question that we need to ask. So I just went and watched Joseph Carlson's video on Google and why he's buying and what he thinks about Google stock. And one of the big things that he focused on was Microsoft's Bing coming into the search engine market and looking to potentially disrupt Google and take some of Google's dominant search engine market share away from Google. This is a big question that a lot of investors are worried about when it comes to Google, and that is, well, with ChatGPT and Microsoft Bing, is this going to disrupt their entire business model and potentially just, destroy a huge amount of market cap? Because the potential worry is that users are going to go over to Microsoft Bing because Bing has a huge advantage in AI with regards to ChatGPT and incorporating ChatGPT into Bing's search engine, which in turn may potentially make it easier for people to search different answers because Bing has this very smart AI chatbot in its search engine. That is the big worry for a lot of Google investors. How is Microsoft going to come in and compete against Google with just that very smart artificial intelligence where you can type in something and then you can ask a question following that relating to what you typed in? Go on ChatGPT and just do a little bit of typing in and you'll see how advanced the technology is already. And as Satya Nadella said, we want to try take away some of Google's market share. The CEO of Microsoft has said that. He said, at the very least, we want to make Google dance. Now, Joseph Carlson, that's one of the things that he's been focusing on. He seems to think, this is what he said, he thinks most likely, if anything does happen, Bing will take away a slice of Google's market share, but Google will continue to dominate the search engine market as a whole. Now, I generally disagree with this. I think with regards to search engine, if you look at the search engine market, if you look at the history of it, it's only been basically one player. It's like a one player dominates everything type platform where Google just took over the whole world when it comes to the search engine market share. Obviously in China it's a bit different because of the Chinese government, but over there also seem to be mainly a one-player game with Baidu dominating. So I think in the future, most likely it will be a one-player dominates everything with the market. But okay, I can sympathize with the idea that maybe Bing or another search engine can come and take away a slither of market share when it comes to certain type of searches that users will look for. So maybe that will happen. Anyway, so his conclusion on why he likes Google, conclusion, was that he thinks the stock is cheap, 17 forward PE ratio. Are you serious? Which is the same average price as the overall market. So he's saying that Google's price is around about the average price for the overall market of stocks, but he thinks the quality of Google's business is a lot better than the overall market. Hey, that's not a bad theory. Then I went and watched Everything Money's video, and they said they've been waiting for a long time for the stock to go below $100. They said it's got a good profit margin, a high return on equity, high return on invested capital, a good moat, and they did their intrinsic value. They had it around, the price was around fair value. So it's the basic sort of thing that they think. The price is not bad, and they love the business. Yeah, that's what they think. Now let's do our own analysis. No, I shouldn't say our own analysis. Let me do my quick analysis of Google stock, and then, very importantly, let's put a value on the stock. Let's go to our intrinsic value calculator, try calculate the future cash flows of Google, and then discount them back today, aka the Warren Buffett's method of calculating the intrinsic value. He says the value of a stock is its future discounted cash flows. If that doesn't make sense to you, don't worry too much. If you keep listening to these types of videos, keep watching Warren Buffett interviews, it will start to make more sense. Basically, he's saying the value of a business is how much cash that business will produce in the future. It's pretty basic, no? Now, I've recently been listening to Charlie Munger's lecture on elementary worldly wisdom as it relates to investing and business. And that's just because I have so much time on my hands and I'm a nerd and this is what I do in my free time. And Munger, in this talk, he talks about different mental models and ways to understand businesses and how they tend to work. One of the models that he used was called Economies of Scale, and this is taught in universities, and this is quite a well-known concept. Do you guys know what it means when a business has economies of scale? Essentially, it means when a business gets so big, they have certain types of advantages over other businesses. For example, think about Coca-Cola. Coca-Cola, because of their distribution centers, because they're so big everywhere around the world, they have this massive economy of scale in that they can distribute their Coca-Cola products everywhere, basically everywhere. And now their brand name is so well known, everyone knows what Coca-Cola is, what it tastes like. People see this, they associate their knowledge with an amazing taste, that other people love it, and they think, okay, I'm going to buy this Coca-Cola product. I don't mind paying a little bit more than for this product than another unknown brand. So because Coca-Cola is so big, they have economies of scale when it comes to their massive distribution center. Now let's relate this to Google. Google has massive economies of scale when it comes to their brand name, their data that they've stored through billions and billions of people searching on Google. So Google know the habits of how many users around the world, what they want to know, what they're searching for, what they like. Google's data is crazy, and apparently one of the most important things when it comes to AI is data. So you think about the economies of scale when it comes to Google. How will a small search engine even try and compete against a mammoth like Google? You'd have to be a massive trillion-dollar company with heaps of spare money and a massive AI advantage even to think about competing against Google, aka Microsoft is the only company that even has the slightest of chance to even try compete against Google right now. They're the only ones who's basically even trying. The rest are just like, oh yeah, Google, you can just have the whole market when it comes to search engine. You're just too good. But never forget that economies of scale also often come with disadvantages. And one of the main ones is when these businesses become overly bureaucratic. Munger says when they get full and fat, it can lead to dysfunction. So the example that he used was CBS. When they used to dominate the TV industry back in the day, they became full and fat, so to speak, and their CEO, Bill Paley, started to make all of these crazy acquisitions. He gave 20% of CBS for the Dumont company, which was destined to go broke just a few years later. So he gave 20% of this amazing business to buy this terrible business. And this was one of the disadvantages with economies of scale, because the business became so bureaucratic. They had all of these different investment analysts and all of these different highly paid positions, but they were all they weren't working as one mind. It was just too big and they couldn't make smart investing decisions. This is an example of disadvantages when it comes to economies of scale. When you think about Google, maybe some disadvantages you could think of is if they started ranking searches based on making as much money as possible instead of what the user actually wants to see when they type in something. Or let's say Google on YouTube, right? Let's say YouTube became so bureaucratic and started to ban certain creators on their platform. That would potentially be too bureaucratic and allow other competitors like maybe Rumble to come in and compete if you become too bureaucratic and you start making bad decisions. So when a business becomes so big, they have big advantages with economies of scale, but Munger talks about there's often a complete opposite force where they become bureaucratic and it sort of fights against one another. Our job as investors is to determine, well, which one will win out. Are they avoiding the disadvantages of economies of scale and taking advantage of the advantages of economies of scale? That's what we have to work out with Alphabet stock. If you want a more in-depth analysis of Google Alphabet stock and get to know its business model a bit better, just watch this video here. But right now, let's move on to my intrinsic value of Google. So as always, I will do a bear case, a normal case, and a bull case scenario for the stock for my calculation of the intrinsic value of Google stock. So let's start with the bear case scenario. So for this one, I'm going to do a 7-year analysis of Google stock. We're going to use our usual discount rate of 10%, aka I want to get a 10% return on Google stock when I buy it. Now we need to determine two key things. What is going to be the future growth rate of these free cash flows, and then what will be the terminal multiple, terminal PE that we sell the business for. So let's look at our analyst estimates. Our analyst estimates for the future growth in earnings or free cash flow, kind of similar, is around an average of 15%. As you can see, some years are above 15%, some years are below, but I worked it out. I did the calculation, added them all together and divided them by 7, and the average was around 15% year over year growth in earnings. Okay, so that's what the analysts expect. However, often the analysts do get it wrong. Always remember that. And now let's look at the prior growth rate of free cash flow. So the prior growth rates of free cash flow were the 10-year year over year growth rate average is 12%, 8 years is 13%. 5 years, they started to do really well and just grow crazily, 21%. And over the past 3 years, they've just done crazy good. They've grown at 31% year over year. But the 10-year average is 12%. Anyway, so now you've seen the historical growth rates and you've seen the analysts' estimated future growth rates. So for our bear case scenario, I'm going to say that the future growth rate for Google's free cash flow grows at 5% each year. So that is well below the historical average, 10-year average, and well below what the analysts expect. Now for our terminal PE, I'm going to be very, very bearish on it because that's our bear case scenario. And I'm just going to use 10. Right now, Google's PE is 22. So in 7 years time, we're assuming it's 10. So that is very, very bearish. Let's do our calculation now. So as you can see, based on our bear case scenario, we get an intrinsic value for the entire company of $783 billion and a per share value of $60 a share. So that is 41% below the current share price of $101 a share. So bear case scenario, it's not selling for intrinsic value. But remember, we were extremely bearish with this scenario. So the assumptions for the bear case scenario would be that the economy slows down, and what is the one major thing that businesses cut when the economy slows down? What's the one major expenses businesses cut? That would be the advertising expense. And what is Google's main source of revenue? Advertising. So if the economy slows down, then Google will grow at a lot lower rate of clips. So that's the assumption there. Also, we're assuming that Google will struggle with Microsoft Bing and their new search engine, which incorporates AI. And we're also assuming that perhaps Google become more bureaucratic and they don't handle the economies of scale as well. That is for our bear case scenario. Now let's move on to our normal case scenario. So we'll say that Google's future free cash flow grows this time at 10%, which is still below their historical growth rate, and it's still below what analysts estimate. But even with the normal case, I'd want to assume that assume the law of big numbers, that the bigger the business gets, the harder it becomes to grow. So that's why I'm doing a lower future growth rate compared to the past. And the terminal PE, right now the PE is 22. So let's still be conservative and say, well, 16 is the terminal PE. Okay, so this is for our normal case. Let's see what it comes up with. Oh, okay, so basically, right, that means Google is intrinsic value is just above its market cap. So based on these assumptions, Google is selling for $1.38 trillion for the entire company and $105 a share compared to $101. So that is based on these future projected cash flows growing at 10% each year. And then after 7 years, we sell the business for a terminal PE of 16. So that's the intrinsic value there. So basically that means based on the current price, we can expect around a 10% return based on the normal case scenario. This is assuming the economy does okay, Google remain the dominant player in search engine, wiping out Bing, and they can still manage economies of scale quite decently. Lastly, let's finish with our bull case scenario. So a bull case scenario will assume that the analysts are right and that Google's earnings or free cash flow grow at 15% year over year for the next 7 years. And we'll assume that, well, we can still sell the business for a decent PE too. Let's assume we can sell the business for the same multiple that it's currently going for now. Okay, so these assumptions, basically we assume that the economy is going to do well, that Google managed their economies of scale very well, that Bing cannot compete against Google, and Google managed to incorporate AI into their own search engine, and things continue to go smoothly. This is the bull case scenario. Let's see what it comes up with. So there, even for the bull case scenario, the company's intrinsic value is $2.31 trillion, which means it's selling for 73% above the current market cap. If you look at that on a per share basis, that is $176 intrinsic value per share, well above the current price, 73% well above the current price. So there, I've given you 3 scenarios of what may happen with Google. Honestly, I really like the business. The main questions that we have to ask ourselves is, well, how will Google be able to compete against Bing's AI and Bing incorporating ChatGPT? Some people think that Bing are going to do a really good job of taking market share away, But a lot of people say, no, Google are so big, they have so much data, they should be able to incorporate their own AI and just continue to dominate the market share. That is one question Google investors need to ask themselves. The second one is, well, how will they manage economies of scale? Will they continue to make the right decisions, giving the users what they want? When the users search something, will they give relevant search results? With YouTube, will they be a great place for creators to come and create videos? Will that be the same? Or will they become too bureaucratic and start making these crazy decisions? Maybe like banning creators or stopping certain people. What's going to happen there? Another question is, what's going to happen with the economy? The economy's done so well on average over the past 12 years, but things can't just go amazing forever. There are sometimes periods where they just slow down, and there's even been periods in the past where we've had quote unquote lost decades where the economy's been flat or the stock market has made no money for 10 years, 15 years. Go look at it. Look at, what was it, 1929, the highs in 1929? When did the stock market reach those highs later on in history? It took, I don't know, it was like 15 years or 20 years to reach those highs. There have been lost periods in the stock market. So these are the types of questions Google investors need to ask themselves.